So the question is, of course, as we were talking about, the Fed coming up on their meeting in July, that's highly expected. It's almost a lock that the Fed will hike interest rates by 25 basis points. And pretty much they don't have a choice. They've already stated that they're going to hike rates. And if they don't do that, it will appear that they are too dovish and the markets could lose confidence. I'm not sure the market has confidence in the Fed anymore. They just kind of hope they're going to cut rates. But that could impair, the Fed's credibility if they don't hike rates. So, pretty much guarantee they're going to hike rates 25 basis points. The question is going to be, is that the last one, or do they continue to talk about the potential for another rate hike as they have alluded to, really kind of earlier this month and last month?
Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to The Real Investment Show. It's the second best day of the week. That's right, getting ready to close out the week already. It's gone by quick. And also, kind of officially, sort of, maybe a little bit today, we kicked off earnings season. Pepsi announcing earnings. Beat earnings, of course, because we lowered the bar. Now they beat it. But really over the next couple of days, tomorrow, Monday, Tuesday, all the big banks are going to start reporting. So really officially moving into that second quarter earnings season. Lots of high hopes here. Markets have rallied strongly this year in anticipation of that. One of the stocks that have really rallied strongly this year, of course, up over 160% this year, is the indomitable NVDIA, which has been all about AI and what's going on. And very interestingly, just yesterday, Elon Musk launched his latest new company, right? It's called xAI. It is his new artificial intelligence company. So along with SpaceX and Tesla, now his next venture is now called xAI. Now, why is this important? Well, he basically ordered thousands of GPUs from NVIDIA. So one of the reasons why NVIDIA had such a strong outlook was because of this launching of this company that had been talked about, but Elon Musk in there buying thousands of GPUs to launch this new AI company. Of course, his team that he's brought in is a collaborative effort from some of the biggest projects from both ChatGPT and OpenAI and others, all coming together to launch this new company. And his goal is to basically use artificial intelligence to discover the universe for the most part. But more importantly, is to bring truth to what AI is actually putting out. So it'll be a very interesting project that he's working on. But here's the interesting, kind of tie here. Given the expense of these GPUs, and some of these GPUs can run into the hundreds of thousands of dollars to do this, and you need a lot of them to do AI projects. And we've talked about this before, is like how many companies out there have the capital to purchase large quantities of these, right? And there's not that many out there. So one of the things is that, yes, xAI provided a lot of buying of these GPUs from NVIDIA, which showed up in their earnings outlook. The question is how sustainable is that? Is there a slate of more xAIs out there to continue buying these chips in order to get, and these GPUs, both chips and GPUs, to continue to support the earnings outlook for NVIDIA going forward? This is just one of the challenges that we're going to have to kind of watch, as particularly whenever we go into a new venture like this. First it was the .com, and then of course the web developed and all this. Now we're into this new AI phase. Question is, how sustainable is it? Of course, it is going to be sustainable. Don't get me wrong. AI is going to be here. It's coming. But how many companies have the ability to spend hundreds of millions of potential dollars to launch a new AI company? Yeah, Elon Musk can do it because he's got billions of dollars sitting in the, kind of in the background. And, he's got the capability and cash and network to do that. A lot of companies don't, particularly in the smaller realm. So the question is going to be coming again as we take kind of watch NVIDIA. It's been all the talk. It's just how sustainable are 50% growth rate in earnings? And odds are they can't sustain that rate of growth in earnings over time. So you have to come back to the real valuation question ultimately of what is NVIDIA worth, going forward. Now, again, that totally bypasses the whole conversation about just pure rampant speculation and enthusiasm about the markets. And there's certainly A lot of enthusiasm. Sentiment positioning now reaching back to very bullish levels at the investors. Sentiment rising up back to previous highs. And as of yesterday, now new talk about all-time highs in the market by the end of this year. Goldman Sachs survey of clients have a lot of their clients asking, are we going to make new all-time highs by the end of this year? Of course, that's all going to be dependent on earnings. And of course, as we go into second quarter earnings season, we're going to get a good, real kind of sampling about just how good those earnings are. Nonetheless, yesterday, of course, that was the big CPI report coming in a bit cooler than expected. We're going to talk about that a little bit more with Michael Lebowitz this morning. And does that change the Fed's outlook on rate hikes of 1, 2, or more? Does that decline in CPI yesterday have much to do with that? When we come back from the break, we'll pick up with Michael Lebowitz. We'll get into the CPI report from yesterday, and also what does that mean for the Fed, the rate hike at the meeting coming up, and rate hikes after that. Don't go away. More of The Real Investment Show coming up.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
And welcome back to the show this morning. You know, younger generation is always doing stuff to get fame and fortune, you know, on social media. And of course, we've seen a lot of people do really stupid things on social media, from eating Tide Pods to a whole variety of other things to try to get clicks, views, those type of things, right? And the hope is to become the next Mr. Beast. If you don't know who Mr. Beast is, he's one of the leading YouTubers and TikTokers out there that does kind of wild and extravagant, you know, events to gain views. And of course, he makes a lot of money from doing this. He makes millions of dollars a year from, you know, being an influencer, and that's of course the new job role. I haven't seen a college course yet for the job role of influencer, but I'm sure it's coming. You know, I have a degree in being an influencer. I'm sure it's coming, you know, right along with basket weaving. But, you know, here's a job posting that was put out in a paper that is right down the line for a young individual that wants to get fame and fortune on this. Human bait needed. Volunteer position for Bigfoot research project this fall in Texas. Safety not guaranteed. Must have strong work ethic, some camping skills. The reward? Fame. Visit human-bait.com to apply. So if you're interested, human-bait.com, and you too can go spend some time this summer seeking out Bigfoot. All you need is some Jack's links. I mean, that's it. So anyway, this morning, as I was saying earlier, PepsiCo announcing earnings. They beat estimates, raising their full-year outlook, even as higher prices are hurting demand somewhat. Thought this was interesting, though, because Delta, the airline company, they posted record quarterly earnings, and they're hiking their full-year outlook on travel boom. Now, again, pay attention to these headlines that are coming out because, again, lots of people talking about, recession's coming. You know, this is all going to happen. The lag effect of these Fed rate hikes is going to impact the consumer. Higher credit card rates are going to impact the consumer. But consumers are still traveling, right? They're still tapping their credit card debts. They've still got income coming in. And like I said, Delta's just posting record quarterly profits based on a travel boom that's going on. So that certainly isn't a sign that correlates with this whole idea of this impending recession right around the corner. ISM services indexes are ticking back up. Consumer confidence is improving. And as I said in the open, and this all kind of ties into what the Fed's dealing with, is, you know, the Fed's been hiking rates with this idea of, hey, I need to slow down economic demand. I need to raise unemployment so that we can bring inflation down. But, you know, a rising stock market increases that wealth effect. People feel more, they feel better about spending money on something like, let's take a trip because, you know, my portfolio's up another, 3% over the last quarter. I feel good about that because that money is actually, it's kind of a free trip. My portfolio has risen enough to pay for the trip. So, it's kind of a free trip. Let's go take it. That increases consumer confidence, increases consumption in the economy. And that is all easing monetary conditions which is undermining exactly what the Fed's trying to do. So Michael Lebowitz joining them this morning. Of course, we've got the Fed meeting coming up later this month. Pretty much a shoe-in bet right now that the Fed's going to hike rates another 25 basis points. The market, and this was really kind of the rally yesterday, based on that inflation number, the market now betting on it's a one and done now with the Fed. Of course, that's also what they thought about earlier this year with the markets as well. But Mike, it's a real, this is a real problem facing the Fed. Inflation's coming down. They said their goal was their goal was never to get to 2% inflation. What the Fed said was, we're looking for a clear trajectory of inflation falling towards our target rate of 2%. Clearly have that now. In their kind of, support for raising rates is getting, pretty much, eaten away at this point, eroded by what's going on. And the markets are now starting to really bet pretty hard that the Fed is now done hiking rates, and the next thing to come, obviously, are rate cuts. What's your take on yesterday's inflation report, and what does it mean for the Fed?
Yeah, the inflation report was great. Just about every set of, the headline data, and then if you dig into the weeds, everything was good. Powell's key inflation barometer, which is core services, so that excludes food and energy, just services, and it excludes shelter. So it's, a small part of, or it's a part of CPI, but relatively small part. That fell more than expected. All the core data, the headline data was all slightly lower than expected. One thing we wrote about for our commentary today is the difference between these year-over-year numbers and the monthly numbers, and they can be very misleading. So year over year basically is the last 12 months. So as you move forward every month, you're taking away whatever that inflation reading was from 12 months ago. Inflation was running rampant. I think it was 1.2% a year ago. That just got taken out of the year over year CPI. So no matter what CPI did yesterday, the year over year rate was going to fall, pretty drastically. And that's what happened. It dropped from 4% to 3%. And it wasn't a surprise to anyone because the market was expecting 3.1, 3.2%. But you have to be careful both ways with these kind of what they call the headline numbers. If you open up your newspaper this morning, go online, you're going to see inflation fell from 4 to 3%, which is true. But what I like to look at is, what are the monthly numbers? What if you annualize the last 3 months? And the story is also very good there as well, that the rate of inflation is probably 2.5%, 3.5%. It's been fluctuating a little, but the year-over-year data for core is still pretty high. But again, if you dig into what the recent trends are, they're much lower. So to your point, Lance, I think you're right. I think the Fed is starting to get into another kind of trap, that they don't want to lower rates, but inflation is meeting their expectations. So, this gets interesting. Is there a soft landing, a no landing? Is the economy just going to continue to roll from here? I still believe in the lag effect. I mean, I just think it's going to take a while for these interest rates to fully affect the economy. Now, if the Fed can get interest rates down and the bond market can do the Fed's job and get interest rates down, you offset some of that lag effect. But I still think there's a lag effect, but we're not going to feel it economically until the labor market softens. And, right now it doesn't appear the labor market, there's some, nascent signs of weakening, but nothing that should disturb anyone, or nothing that you can say is trending in a direction that should be concerning. So, again, with the CPI data, I think it just says all eyes on the labor market. So, we'll look at jobless claims this morning, and then on a monthly basis, we get the BLS reports, the ADP reports, the JOLTS reports. We get our surveys, the University of Michigan consumer survey on employment, and try to put it all together. And it seems like it's smooth sailing until we see signs that the labor market is struggling in any way.
Yeah, and the I guess the question is a year from now, are you still going to be sitting here going, oh, well, I believe in the lag effect. It just hasn't shown up yet. This is the challenge. There's so much money that's coming into the economy. We've had so many spending bills passed, by the administration for inflation reduction and this bill and that bill. I mean, it's literally just trillions of dollars that are still cycling into the economy, which is, keeping things, running at this point. And again, while we've had, a very strong labor market, we're only back to where we were really kind of pre-pandemic. We've just kind of put everybody back to work. So, there's, potentially if the economy is running kind of at a normal basis and can sustain these higher rates on the short end of the curve, that's the big question. There's, potentially a reason that the economy may just kind of keep chugging along here because of all that monetary liquidity. And when you take a look at M2 as a percentage of GDP, it's still extremely elevated. There's just a lot of money sitting out there right now. And that's and again, you take a look at Delta and Pepsi and others, consumers are weathering these higher interest rates and higher costs. It's tampered demand a little bit more for Budweiser than others, but, it's consumers are still hanging in there. And the question is, and again, there's the old saying, of course, never bet against the consumer because they're very crafty about coming up with ways to spend money. And they seem to be doing a good job of that.
Right. And there's a lot of pent up demand, right? We saw this with UNH about a month or two ago, where they said insurance claims are rising for elderly people that are doing elective surgery.
Yeah.
Right. I think we're seeing that with travel. We're seeing that with going out to dinner. There were a lot of people that were still kind of locking themselves down to varying degrees not that long ago. Mm-hmm. So they're coming out of their caves and they're spending money that they've been saving for 3 years. They're meeting their demands that they've been deprived of. Things they want to do. So just don't look past some of that stuff either. And that's why we've seen it month in and month out. The economic gains are coming in entertainment, travel, restaurants, leisure,
Yep.
Those industries.
Well, and again, look, we're going to have another good litmus test coming up. Really Friday, Monday, Tuesday next week when we start getting reports of just how good Amazon's Prime Day was, of course, which really kind of kicked off yesterday. We'll see, how robust consumer spending is. Amazon will give us kind of a good first crack at just how resilient the consumer is, or do we see a big decline in it, right? Does Amazon Prime Day actually flop this year? We'll find out in a few days, but I'll tell us a lot about really the status of the consumer as well. Okay, quick break. We'll come back. Kind of following through with this whole idea of the Fed hiking rates. The question is, and of course what the market's betting on is they're going to be cutting rates. The question is why? We'll talk about that when we come back with Michael Lebowitz. Don't go away.
You're listening to The Real Investment Show.
So the question is, of course, as we were talking about, the Fed coming up on their meeting in July, that's highly expected. It's almost a lock that the Fed will hike interest rates by 25 basis points. And pretty much they don't have a choice. They've already stated that they're going to hike rates. And if they don't do that, it will appear that they are too dovish and the markets could lose confidence. I'm not sure the market has confidence in the Fed anymore. They just kind of hope they're going to cut rates. But that could impair the Fed's credibility if they don't hike rates. So, pretty much guarantee they're going to hike rates 25 basis points. The question is going to be, is that the last one, or do they continue to talk about the potential for another rate hike as they have alluded to, really kind of earlier this month and last month? But the real question comes, of course, and what the market's hoping for is that the Fed is going to start cutting rates. And this becomes an interesting conversation because the belief of the market is that because inflation is falling, that the Fed needs to cut rates. But the question that I have is well, if interest rates are 5% and the economy's doing fine and consumers are spending and weathering, higher rates, why would I cut rates? Higher rates increase net interest income for the banks. Higher interest rates give, lenders the ability to make more money on loans that they're putting out there. There's some positive benefits of higher rates. And if I cut rates now without the economy in a recession or having some, need to do so, then I use ammo, kind of that I would use for a recession, really not for much, for not much benefit. So the problem I have, Mike, is why would the Fed cut rates unless what you're expecting comes to pass?
Right. And here's something else to think about. What if the Fed 6 months ago thought they had the battle won and dropped rates to 0% or back 1 or 2%? What would the economy be doing now? Or if they had never really raised rates, the economy would be a lot stronger than it is today. The market would be up a lot more. That would be feeding the economy, right? So the Fed is restraining the economy. So I think what your real question is, why would the Fed not keep restraining the economy? The economy is at a good, it's like walking a dog. You're walking at a good pace. The Fed likes the pace. Why would you want to pick up the pace at this point and potentially create more inflationary pressure? I just don't get the case for it unless you have real banking problems.
Right.
We know the Fed will do whatever it takes to save the banks. That involves inflation. That involves layoffs in the economy. That includes recessions. So the Fed will do what it takes to save the banks. But barring bank issues, there's not really a case. Even if inflation starts printing around 2% pretty steadily, to really lower rates. They may do a marginal 25 here or there. But again, if I'm them, I save that ammo for a rainy day.
Yeah. And, speaking of, though, that's a great point. Starting really next week in earnest is the big banks. I think we have a couple of banks maybe tomorrow. But we've got most of the banks are going to be reporting earnings next week. And to your point, the question is the banking crisis over? Right. We had this whole big banking crisis back in March that lasted about 37 seconds. The Fed came out, created the BTFP or P fund to bail out these banks. And this, then that seems to have worked at this point. And, there's not been much of a mention of a banking crisis since then. Markets have continued to improve. Bank stocks they're not pacing the market this year. They're not up that much, but they're not going down. So we're about to hit earnings season for that, and I'll just read to you a clip from the Wall Street Journal this morning asking the same question. Lenders will sort through the damage from this year's banking crisis when they report their financial results starting on Friday. Earnings for the second quarter will show whether recent failures of 3 lenders and the slowing economy are eroding what has been a long period of strength for the industry. Earnings are expected to fall about 7% in the quarter from a year earlier. This is according to Keefe, Bruyette & Woods. And the biggest banks are expected to have fared well and in some cases thrived. Of course, JP Morgan leading the way. And a lot of that thriving is coming from these higher interest rates, right? That increases the net interest income for banks. Basically the spread between what they borrow at and what they lend at is what generates their profit. Of course, the big thing out there is this $3 trillion worth of commercial real estate debt that's sitting on their books. This has kind of been one of the big concerns, that there's going to be this commercial real estate kind of impact to banks, and it's certainly not a small impact. There's 1 billion square feet of empty, vacant commercial real estate space in the country right now. So there's certainly some risk on that side of the ledger. And of course, they've got a lot of losses because of the rise in interest rates. And of course, this is what created the banking crisis earlier this year, was the degradation of the prices of the bonds they hold as collateral in their books. Those things haven't gone away. They're potentially not getting much worse at this point, but they're certainly not getting better. Your thoughts?
Right. Yeah, the margins are the big issue. So you have kind of 2 phases of bank earnings. The big boys actually start tomorrow, JP Morgan, Bank of America, those guys. What we're going to want to listen to from them is what's going on with their margins. Are they still seeing deposit outflows? How much are they putting aside for potential credit losses? So that last one will tell you what they think about the economy. not what they tell you, but what they're actually thinking. If they're putting away more than expected in credit reserves, then they have a worse outlook. And if they're putting away less, then it's maybe a little better. But I think margins are the big problem facing banks. It's not, the economy's fine. Right now, there's not the credit risk is not too big an issue. Bond prices have stabilized. So that part of their balance sheet is not getting worse. But the margins are among the lowest they've been in 30 years. They're just, when they have to borrow money at 5%, 5.5%, and lend it out at 7%, 7.5%, there's just not much in it for them like there used to be. But the following week, we'll get all the regional banks. And that's where it gets a little more interesting, because the deposit outflows are much greater for those banks. And we'll see if that started picking up again as rates kind of ticked up a little bit towards the end of last quarter. And they're the ones that have had to sell perfectly good securities at losses purely because of the interest changes in interest rates. So I think the story gets more interesting next week. The story this week from JP Morgan and others is, I think, more an economic story. What do they think about the economy based on what are they doing with their credit reserves?
And again, yeah, and these loan loss reserves are always an interesting thing, right? Because if they put money into loan loss reserves, that's an expense to earnings, and when they don't use them and they bring them back on, it now becomes income. So you also kind of, when you're looking at bank earnings, you also have to track where their earnings are coming from, because again, let's say that JP Morgan puts away $1 billion worth of loan loss reserves this year, and next year there's not been a credit crisis, so all of a sudden their earnings will jump by $1 billion because they'll bring that same billion back. They didn't earn $1 billion more; they just moved it back from loan loss reserves. So this is why it's always important when you're analyzing financial statements and earnings and these type of things. As investors, we tend to just kind of take the headline and run with it and say, oh, they beat earnings, so let's go buy the stock. And that's the way the market works in general anyway. But it's important to really dig down. Quick. Yeah, just real quick. It's just important to dig down below the headlines and make sure you're really buying what you think you're buying. Mike, go ahead.
Right. And real quick, when you're looking at bank stocks, they're different than every other stock because of just everything about them. Like you said, the credit losses. There's so many other aspects that you can't value them the same way you value other companies. Our typical price to sales, price to earnings, all those type of valuation metrics just aren't quite the same. Cash flows. If you look at a lot of financial statistics regarding kind of industries, it's always X financials. It's just a different animal than kind of your more typical company. So just be careful if you're looking at bank stocks and say, no, it only has a PE of 5 or this and that of whatever. Yeah. It's not apples to apples versus a more traditional company. Yeah,
and it's the same way with REITs too. Because of the leverage that is used in real estate, so you can't look at leverage ratios the same way you look at, say, an industrial or a tech company. So this is and this is the important thing about as you're investing. And if you still actually do any type of fundamental analysis rather than just buying what's going up on the chart, it's important to understand, where earnings are derived from, what these things mean, what these ratios mean, to make sure you're actually buying what you think you're buying. But unfortunately, we kind of got rid of fundamental investing about a decade ago. So I'm not sure it actually matters anymore. But, we keep hanging, us old guys like me and Mike, we keep hanging on to fundamentals. We think they're going to matter someday. My tombstone will say, here lies Lance Roberts, who still believes fundamentals matter. But, that may not be too far in the future. But, when we come back from the break, I want to pick up. Mike wrote a really good article yesterday. I want to touch on that. I'm also reprinting it in the newsletter this weekend because it's something that will potentially have a big impact on the future of the markets. And I've got a couple of questions to throw at Mike about it as well. So we'll discuss it when we come back from the break. Don't go away.
The Real Investment Show.
So just recently, the Federal Reserve put out a white paper talking about the end of an era. Michael Lebowitz did a really great job parsing that article yesterday in a blog post that's on our website right now, titled the same thing, The End of an Era. And so if you go to our website, realinvestmentadvice.com, you can download the article and get all the relative charts and graphs. But in a nutshell, Mike, I have a couple of questions to ask you about the article, but just in a nutshell, give us a kind of a brief synopsis of what the Fed paper said about the end of an era and why is it the end of an era?
So basically what the author did was say how much, so we know over the last 30 plus years, interest rates have dropped steadily and effective corporate tax rates have also dropped significantly throughout the 30 years. So basically all the author does is goes back and says, how much did just that contribute to corporate profits? And at the end of the day, he comes up with a number of about 40% of corporate profits were due to interest rates and tax rates, which is interesting. It's not shocking at first. I was a little surprised it was that high, but it's not surprising. So, I'm kind of reading the article and then I go back and I say, okay, well, let's just look at GDP and corporate profits. GDP and corporate profits should be very similar over longer periods of time because essentially GDP is profit. One is feeding the other. They're all kind of intertangled there. So if you look at the last 30 years compared to the prior 30, 40 years, the prior 30, 40 years, you'll see that corporate profits and GDP both grew around 7.5%. Over the last 30 years, GDP has only grown about 4.5%. Corporate profits continued to grow at about 7.5%. And that's the difference. The reason that corporate profits have grown 3+% a year more is from the steady decline in interest rates and tax rates. So, first part of the article summarizes what the author says, and it shows some of his graphs. We created a few graphs too. And, when you really think about it, it is pretty startling what's happened with both. Tax rates have come down roughly 25%, and interest rates for a lot of companies have come down from 8 to 10% to 1 to 3%. So then I was like, okay, this is great, but let's see if this actually ties out with what we're seeing from companies. So I randomly picked McDonald's. We kind of wanted a nice, steady growth company, value growth company, not a company like a Microsoft that has had massive growth and it's hard to attribute interest rates and other things to. So we looked at McDonald's and steady profits, so its tax rate is a little more dependable. And sure enough, with McDonald's, over half of their profits have come from those two factors. We looked at Pepsi, we looked at Coke, we looked at Clorox, same story. Somewhere between 35 and about 55% of profits purely came from interest rates and tax rates. So that's great. That's great to know. The question is, what does that do for us going forward? And this is where the author and ourselves kind of come to the same conclusion, that those were benefits. The question is for those benefits to continue. So for corporate profits to continue to grow more than GDP, you need lower interest rates and lower tax rates. And unfortunately, interest rates they're going to go lower from where they've been the last year, but they're really not going lower from where they've been the last 5 years, which is, not zero, but pretty close to zero. Tax rates, effective tax rates are in a 15 to 20% range. Sure, they can drop another 20%, but given the deficits that the government is running, it's hard to see how they reduce taxes anymore. So you're kind of left with the conclusion that if rates stay where they're at today, then corporate earnings are going to actually get worse, or corporate earning growth will weaken. And taxes are probably going to stay the same. And there's a chance they go higher to help pay for some of these deficits. So I think where that leads us, and this is over the long term, this doesn't mean that tomorrow you got to sell all your stocks. over the long run, we should expect corporate profits to be running a lot closer to GDP. GDP, nominal GDP, this isn't real GDP, is running 4.5%, and the trend is lower over longer periods. So,
that's a function of debt, by the way. Is the reason the trend is falling on GDP is because of the rising debt levels. Go ahead.
Right. And if anything, debt's risen by a lot more over the last few years. So that trend could kick it up a notch too. So, the problem we have is that we have valuations that are much higher than normal. You typically pay a higher valuation when you expect a higher growth rate. So if you just look at price to earnings, why would you pay a higher price to earnings than normal? And it's because you think the E in the price to earnings is going to grow more than expected. That would justify paying a higher valuation. So now you have an E that's going to grow. And I think people's expectations are more backward biased, right? So what's happened will happen. So, again, this is aggregate, but I think a lot of investors are thinking corporate profits grow at 7%. Here's what I need. Here's, what I should be paying for it. And I think in reality, over the next, again, not next week, not next month, but over the next 10, 15 years, we're talking about profit growth that's probably between 3 and 4%. So, roughly half of what we've seen, with valuations that are 20, 30, 50% more than the norm. And that's, again, a longer run picture, but trouble for the long run stock market. Now, at the same time, the bond market's offering you, treasury market's offering you 4% for 10 years you can lock in. And, if you go out, with some credit, take some credit risk, you could get 5, 6%. So, if you're an investor that just wants to put an investment to work, go to sleep, not trade the markets, it's something really interesting to think about in the trade-off between stocks and bonds for, a long period of time going forward.
Yeah, and again, we are talking about long-term timeframes here, but the point of this is that the ability to generate the margins that investors have been paying into for the last 20 years in particular are going to be really hard to maintain. Particularly after the margin expansion we saw during the shutdown. There's kind of this belief right now that new high in corporate profit margins are going to remain that way indefinitely, and that becomes more challenging. Now, one of the questions I have to ask you though is that one of the big trends to help boost earnings, over the last 2 decades in particular, has been stock buybacks. How does that factor into this analysis?
It doesn't, and I was using net profits. Just using dollars, right, not earnings per share.
So the point is, and that's right. And the point is here is that people, and a lot of the people are immediately going to ask, well, what does it matter? As long as companies buy back shares, it's fine. You can buy back shares, you can reduce your share count outstanding, but that still isn't going to have the same impact on margins and the ability to expand those margins if you don't have lower tax rates and lower interest rates in the future. So, right, this has become, the question I think ultimately is, we've had really accelerated earnings growth. And to your point, and this is the most important takeaway from this, and I've done work on this, Mike has done work on this, the correlation between GDP and earnings going back to 1900 is extremely high. And it's a function of the fact that what we do in the economy, what we buy, what we trade, what we sell, that is what generates the revenue for these companies. So it is impossible to maintain a divergence between earnings growth at 7% a year, which is what analysts continue to expect going forward, and an economy that's growing at 2%. Without these other benefits being in play. And you can buy back shares all day long, and it's not going to change that outcome if you can't make up the difference between 2% and 7%.
Right. And Lance, what you're talking about, what I'm talking about is in the aggregate.
Yeah.
So that doesn't mean there aren't going to be companies that grow at 40%, but it also means that there are going to be companies only growing at 1%.
Right.
You put them all together.
Right. And this is going to be one of the issues with passive investing. At some point, let's just assume you're right in your article, and I'm a passive indexer, my returns may fall close to zero over the course of the next 2 decades because of this combination of effects of high valuations and a reduction of the ability to make those spreads. But as a stock picker, I could do exceptionally well. And, this may bring back, one of the things that we've talked about is this big kind of mindless robot of passive investing that just sucks in money flows and indexes. It's fine as long as indexes are rising. The question is if you spend 2, 3, 4 years making no money in an index and you see other managers making money picking stocks, that may be the death knell ultimately for the passive investing crowd.
And maybe your tombstone one day will say fundamentals actually did matter.
If I live that long, I got to get another 20 years on the books probably. All right, that's going to wrap up the show for the day, Mike. Thanks so much. Get by our website, realinvestmentadvice.com. While you're there, make sure you're registered for our daily market commentary. We put that every day at 7:30 sharp. Comes to your email inbox. Quick 2-3 minute read, kind of get you set up for the trading day, earnings, economic data. This morning we got PPI to talk about. So that comes out every morning at 7:30. Subscribe for our newsletter. Subscribe for our Before the Bell video commentary, as well as our daily radio show right here. Just click the subscribe button, that little bell icon as well. We'll make sure you're notified every time that we launch a new video on our website as well. So lots of stuff to keep you up to date on the markets, along with our blog posts, more. It's all there at the website, realinvestmentadvice.com. Have a great day. We'll see you back here tomorrow with Danny Ratliff and Richard Rosso for Financial Fitness Friday. See you then.